Good evening, ladies and gentlemen. Thank you for joining us tonight at Corporate Connect webinar, jointly organized by SIAS and supported by SGX. Today we have with us Mr. Geoff Howie, market strategist of SGX, to share with us on market updates, followed by United Hampshire US REIT's presentation and Q&A session. Without further ado, let's welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thank you. If I can just try and share my screen now. Okay. Good evening. I'm intending to provide a quick 15 to 20 minute or so overview on the current drivers of our Singapore stock market, and I guess give the perspectives through those prisms of companies and trusts that are listed on the exchange, in addition to the active hundreds of thousands of investors that are in our market. I must point out that this is a presentation designed to be purely informative. Recent observations are predominantly in the stock market, and in no way are we providing investment advice. So, looking where we are in our market now, you can see we are at this point here. We closed at 31.05 today in the STI after a 31.06 close yesterday. And the blue line is represented by the STI. The green line represents the regional FTSE ASEAN All Share Index. And what's interesting is the rolling 120-day correlation of the Straits Times Index to our broader regional FTSE ASEAN All Share Index. It has on average been some 70 to 75% over the past 5 years. We've seen investors build exposures to the STI in 2020 and continuing somewhat in 2021. The combined AUM of the Spider STI ETF and the Nikko AM STI ETF, it ended last year at 2.07 billion Sing dollars and is very close to $2.2 billion at the moment. But what we also saw is the current 30 STI constituents, they were recipient to $7.5 billion of net retail inflows in 2020. Those same 30 stocks saw 1.2 billion of outflows the year before in 2019. So far in 2021, we've seen these 30 STI stocks see total net retail outflows, I'll just start again. So in 2021, the year thus far, we've seen net retail outflows of $1 billion after the $7.5 billion of retail inflows last year. Now for the STI stocks, it's ranged from $120 million of net retail inflows for Singtel to $560 million of net retail outflow for DBS. The STI stocks in the year to date that have been recipient to the highest net retail outflows, proportionate to market cap, have been Yangzijiang Shipbuilding Holdings, SATS, DBS Group, OCBC, and Singapore Airlines. And these 5 stocks together, they've averaged 20% price gains so far in the year to date. And namely, 3 of the 5, Singapore Airlines, Yangzijiang Shipbuilding Holdings, and SATS, they were among the STI stocks that saw the highest net retail inflows proportionate to market cap during 2021. So we're seeing that rebalancing, the retail investors buying those stocks amongst the weakness last year and selling into the rally this year. Yangzijiang Shipbuilding, it also pushed through its January 2020 highs last week. It's seen institutional inflows help propel the stock to an 83-week high. It was our most traded stock today, and it has been trading more than $40 million of average daily turnover this year. And that's up some 50% from last year levels. Since the end of November, the share price of Yangzijiang Shipbuilding has gained 40% thereabouts, coinciding with a more than 40% increase in the price of Brent crude oil. So on the shipping and the trade front, tomorrow we have important numbers at 8:30 in the morning. We have our non-oil domestic exports for February that will be released. The consensus estimates are for the 3rd consecutive month of year-on-year growth, but a lesser pace is expected for January. So the preceding NODX reports, it revealed 13% year-on-year growth in January, and I think it was 7% year-on-year growth in December. The electronic NODX, it did grow 14% in January, 14% in December as well, but that was attributed to a load base for those integrated circuits back in I guess December 19 and January 2020 because of the the down cycle in the global electronics market at that point. So far, what's interesting too, we've seen the SPDR STI ETF. Basically, the SPDR one has recorded a net outflow of $25 million over the past 10 weeks. So that includes net creations of 67 million with total redemption of 92 million. But while investors have been selling all the time into the recent rally, however, when we look at the other ETF, the Nikko AM STI ETF, with a recorded net inflow of $30 million over the same period, that's because of a net creation of 33 million Sing dollars and redemption of only $3 million. And it basically means together, the two STI ETFs have seen net inflows of $5 million thereabouts for the year so far. And what it also means is the STI outflows, when you look at the pattern of the STI creations and the redemptions, it means the STI ETF outflows were likely offset by the investors adopting that dollar cost averaging approach, investing regularly in the regular share saving plans, which do offer investors that convenient way of investing by committing a fixed amount of money every month and obviously remove the need for market timing. But here and now we have the STI, I guess, at 31.05. It's gained 9.2% in the year to date. Dividend distributions have boosted that total return to 9.4%. And the STI has now returned to within 20% of its May 2018 highs, up near 32.80. The May 2018 highs, which are even more than that, obviously at 36.40. So we're within 6% of the January 2020 high and within 20% of that 36.40 May 2018 high. When we look, I guess, at the lows, we're now more than 20% higher than that 30 October 20 high. So the STI would have to decline by more than 20% to return to that 30th of October 2020 high. Now, the three mega sectors of banks, real estate and industrials, they make up 50% of the FTSE ASEAN All Share Index, the green line, and more than 70% of the STI, the blue line. For those mega sectors to recover further, we do need broader economic recoveries that we have to see, not just in Singapore, but across the region. And that's opposed to that uneven K-shaped sequential growth that we observed in the second half of 2020. And this is very different to the S&P 500 and by extension, the FTSE All World Index that has to maintain an approximate 40% weighting to the two key sectors that have benefited the most from the COVID lockdowns. That's digitalization and medical supply industries, benefiting those two sectors of technology and healthcare. Now, Singapore stocks, they make up 25% of the FTSE ASEAN All Share Index. And the recent moves in these indices, like all global equities, they've been driven by the expansionary monetary policies, vaccine deployment and expectations of sequential economic and earning recoveries this year. The Federal Reserve balance sheet has now grown to $7.6 trillion US dollars, while that's you've also seen the European Central Bank balance sheet now stand at 7.1 trillion euros. The policy stimulus, it's helped businesses in all shapes and sizes, and by extension, helped to fuel the movements in the stocks, the global indices, and the commodities. As of 13th of March, we've had 355 million COVID-19 vaccination doses administered across the world, and total recorded COVID-19 cases stand at 120 million as of that date. These are the key drivers. But just to hone in quickly for the next 7 minutes or so on our REIT sector. Now, since 2002, Singapore has grown to be one of Asia's largest REIT and property trust markets. We have more than 40 property trusts that consist of 36 REITs, 5 staple trusts, and 2 business trusts. The trusts of the S-REIT sector, they currently average a 12-month trailing yield of 6.2%. The median is around 5.6%. The 5 REITs that maintain the highest yields and have generated gains over the 12-month period into early March, they include those with the highest yields: EC World REIT, Sasur REIT, Soil Build Business Space REIT, Ara Logos Logistics Trust, and Fraser's Logistics and Commercial Trusts. Those 5 REITs yield 6.9% on average. The REIT yields are still some 400 basis points above the 10-year yields, but note that while the 10-year yields are used as a comparative somewhat, very often, REITs are not fixed income products. They are collective investment schemes which come with market risks on the unit prices, similar to equity markets. So the combined market cap of the S-REIT sector, it's now at 105 billion Sing dollars, which, like the end of 2020 and 2019, represents some 12% of the combined value of all stocks listed on Singapore Exchange. The S-REIT sector has also grown at an 11% compound annual growth rate over the past 10 years. And through the recent years, the S-REIT sector has also averaged day-to-day turnover of more than $300 million. That's 24% of the combined day-to-day turnover of all stocks listed on the exchange, excluding those security products such as the ETFs. But for the ETFs, we have 3 SGX listed REIT ETFs that do offer diversification into Singapore and regional REIT markets. They posted year-to-date net inflows of $63 million and recorded a combined asset under management of $520 million. The Nikko AM Straits Trading Asia X Japan REIT ETF and the Lion Phillip S REIT ETF are now amongst the top 10 traded ETFs listed in Singapore. The S REIT sector, I should also mention, is very much recognised as a global REIT hub, and it's fantastic to have United Hampshire along with us tonight in the SIAS Corporate Connect event. I should say that as many as 17 of the trusts exclusively invest in property assets outside of Singapore. 20 of the trusts are investing in properties in both Singapore and outside Singapore, and the remaining handful of REITs invest purely in Singapore. This also includes some 10 REITs with properties in China, 7 REITs with properties in Japan, 6 REITs with properties in Malaysia. The trusts are also highly diversified across property types, with a balance across retail properties, industrial properties, office and commercial towers, hospitality, and of course, multiple REITs in healthcare related properties, as well as the specialized REITs such as the data centers and high tech buildings. We should also point out on the valuation front, the valuations are currently highly competitive. The S-REITs, the trusts of the S-REIT sector, they average a 0.97 price to book ratio. It's very close to the 1.0 price to book median for the Asia Pacific listed REITs. While on average, the trusts of the S-REIT sector, they are trading at or near book value. On a median basis, global REITs are trading at a 4% premium to book value. But at the same time, our S-REITs do maintain a lower debt to asset ratio of 37% versus 39% for the global median, and a higher trailing dividend yield with, as we said, that 6.2% average or 5.6% median versus the global median, which is 4.5%. So I guess so far this year, the strongest trusts of the S-REIT sector have been Ara Logos Logistics Trust, Ara US Hospitality Trust, Sabana Sharia Compliant Industrial REIT, Elite Commercial REIT, and Star Hill Global REIT, with total returns ranging from 10 to 20%. Ara Logos Logistics Trust, CapitaLand China Trust, Keppel REIT, Suntec REIT, and Parkway Life REIT, they have seen the highest net institutional inflows, while the most net retail inflows have gone into Mapletree Industrial Trust, Ascendus REIT, Mapletree Logistics Trust, Keppel DC REIT, and Manulife US REIT. Now, you might see a pattern there as well, in that the 2 Mapletree Industrial and the Logistics, Ascendus, Keppel DC REIT, they were amongst the stronger performer REITs last year and saw the net retail outflows, while you've seen retail be buyers or net buyers of those REITs into their weakness this year with the rebalancing. Ongoing securitization of the real estate assets, it does continue to be a sub-theme into this year. Last month, we saw Keppel REIT launch a $270 million placement that was almost 5 times covered, with strong participation from new and existing institutional investors, and 97% of those proceeds to partially fund the REIT's proposed acquisition of Keppel Bay Tower from the sponsor Keppel Land. For the broader drivers, I guess amidst the recent equity rotations and rebalancing, higher 10-year US 10-year yields are really coinciding with global bank stocks really outpacing global REITs. With the longer end of the US 2 to 10-year yield curve increasingly pricing in an eventual economic normalization, we've got the Bloomberg World Bank Index up 18% this year versus the Bloomberg World REITs Index gaining some 8% this year. So this week's FOMC, it will conclude with the regular press conference, very early hours of Thursday morning, 2:30 a.m. And there's no change in rates obviously expected, but the press conference will likely see reporters start quizzing the chair on the 10-year US Treasury yields. It was not discussed at the January FOMC press conference, with precedence given obviously to core areas such as financial stability, employment, inflation, tapering, and then of course the new Biden administration. So where we are, wrapping up, I guess the degree of which global growth can swing from a decline of 4% last year to a gain of 5% this year, it really depends on COVID-19 containment. The efficacy of the vaccine is obviously crucial, as well as second lines of defense against the resurgences and the mutations. The results have mostly been sector driven over the past 12 months and really supported or fueled, if you will, by this expansionary monetary policy across the world. So just as the sequential economic rebound within 2020 was very much uneven across industries, stocks that have been less impacted by the social and economic measures to contain the coronavirus have obviously been outpacing stock markets. We've got a number of reports that we provide updates with that you're probably well acquainted with, but our most recently launched channel is Telegram. The Telegram channel we call colloquially SGX Invest, and we encourage you to find us on Telegram, as the channel does provide the means to send to you once daily, usually, relevant insights that can serve to, I guess, keep you informed on recent developments in the stock market, security products, in addition to some upcoming events. And of course, if you prefer once in a week emails, our SGX My Gateway report has been running for the past 9 years now and has that wide subscriber reach. And we distribute that every Monday night and try to cram in as much as the trading highlights and market developments of the previous week we can, just like I have tonight with this 20 minutes or so. So thank you very much for your time. And I'm now going to switch from a presenter to a listener, and I'm really looking forward to hearing from the management of United Hampshire. Thank you.
All right, thank you, Geoff, for sharing on the market updates. Next up, we're pleased to have with us today Mr. Robert Schmidt, CEO of United Hampshire US, to share with us more on the company. Mr. Robert, please.
Thank you, Christine, and thanks for welcoming us to this seminar this morning. We're happy to participate. It's actually morning where I am, but late evening, I guess, where you are. But thank you anyway. I'm going to give a brief overview of the Hampshire REIT, our offerings and our strategy, and then hopefully we'll have a little time at the end to save for some Q&A. But starting with the overview here is, our headliner is we were the first U.S. grocery anchored shopping center and self-storage REIT launched on the Singapore Exchange. We do believe our retail offering is fairly unique. These are not traditional, more vertical-oriented malls or department stores that are more prevalent in Singapore, but open-air property in the suburbs that offer food, home improvement supply, and generally necessity-based goods and services that are in demand by the U.S. consumer. About $630 million of assets. 22 in total right now, but we're looking to grow that, but 18 grocery and necessity retail, 14 self-storage. And we do have a long WALE, which is how we can produce that yield and stability over time. A lot of that lease term comes from our anchor tenants that when they're new have terms anywhere from 10 to 20 years. The smaller shop spaces are more in that 5 to 10 year category. High occupancy across our portfolio, and it's notable that we've been able to maintain that throughout the pandemic, as most of our tenants are essential users and we're able to stay open despite some of the economic shutdowns relative to the pandemic. Total square footage, 3.2 million square feet, basically all of which is freehold except one ground lease property. Sponsorship comprised of the Hampshire Companies, a 60-year-old real estate development company based out of Morristown, New Jersey, and a group called UOB Global Capital, which is partially owned by UOB Bank. We've had a 10-year relationship with UOB in launching and managing private equity funds as well as separate accounts, totaling about 1.1 billion mutually we've done together over the past 10 years, this being our fourth investment vehicle we've done together. Next page, Tanya. This is a portfolio that's focused on the East Coast US. Why the East Coast? Number one, we are based in northern New Jersey, which is obviously on the East Coast. But these two sectors that we focus on, necessity retail and the self-storage sector, really are focused on generating business from the U.S. consumer, which comprises 2/3 of the U.S. GDP, and 40% of those consumers do reside within driving distance from the Eastern Seaboard. So that is where our portfolio is located. The majority of that is North Carolina and on up, 19 of those assets being in those locations, 3 in the South. The reason we do like the Northeast, it's the most mature section of the country, older, less available land, and the key ingredient being high barriers to entry. So it's very difficult for new retail competition to come into these areas. South is a little more higher growth. Florida is the second most highest populous state now, and that continues to grow over time due to the high quality of life relative to the cost of living. So we're looking to grow right now within those same markets as we move forward. Key highlights. This is an income producing portfolio. Obviously, we focus on stable cash flows. In addition to being focused on the U.S. consumer, necessity retail and self-storage both generate stable cash flows over time. They are cycle-agnostic. They perform well regardless of the economy, and we consider the survival of the pandemic one of the biggest tests so far. And based on the performance this year, which we'll get into in a little more detail later on, we've held up strong and passed the test. These two sectors were the two sectors that recovered most quickly from the Great Recession just over 10 years ago now as well. People are buying food in the U.S., whether the economy is good or bad, they have to put bread on the table. It's a yield and moderate growth portfolio. The majority of the tenants on the retail side of the equation do have built-in rental increases. As I mentioned earlier, the anchor tenant leases, being the food and the home improvement, have longer term leases. The smaller leases, a little shorter, but generally have built-in rental increases fixed on an annual basis. We consider these assets to be of high quality, and these are not mall properties. We need to make that very clear. These are open air strip centers that are located in the suburb United States. They have large car parks. They're convenient for the consumer. They're very safe. Throughout the pandemic, there is a lot of common area. It's very convenient for consumers to park near the stores they're looking to do business with. You get the food delivered curbside or go in quickly and leave. And they're all located, generally speaking, in the rooftop communities where the people live in the suburbs. As I mentioned earlier, primarily infill locations surrounded by the housing, the demographics of people are located. And the last ingredient, e-commerce resistant. The successful tenants in our portfolio have embraced what we call the Omni-Channel strategy. Omni-Channel meaning there's several means of distribution to get the retail goods and services to the consumer, but the actual bricks and mortar store remain as the heart of the distribution channel. So even though people are ordering online in some cases and getting the food delivered or the products delivered, the bricks and mortar store acts almost as a warehouse, and all the transactions are done and delivered from the bricks and mortar store themselves. And we expect to see that trend continue going forward. And investment in technology will continue to keep that store relevant going forward. Next slide, Tanya. Mentioned the word essential previously. That is the key ingredient for our tenant usage. A lot of you may have read throughout the course of the pandemic that a lot of the non-essential users early on in the pandemic were forced to shut down. Some of our tenants are non-essential. Over 70% are essential though. So the headliners being grocery stores, hardware and home improvement stores, medical users, gas stations, pet stores thrived during the pandemic. People actually bought more pets during the pandemic and needed more food and supplies. So convenience stores thrive, liquor stores thrive significantly. So because of these essential users, most of these stores have been able to maintain themselves operationally, despite some capacity limitations at various points throughout the pandemic, but they were able to keep open and continue to conduct business. There were a couple areas that we need to keep an eye on. Obviously, restaurants, even though they actually are considered essential, indoor dining was extremely limited. So some of these restaurants have struggled. And then the fitness clubs have also had been challenged because of the capacity limitations in an effort to curtail social distancing and keep consumers safe and healthy throughout the process. But I will say our two largest health clubs, LA Fitness, have actually made, excuse me. Sorry, guys. Health clubs have continued to perform despite some of these limitations they've been faced. Why don't you go to the next slide, Tanya, and hopefully I'll get my voice back by the time we get to the next slide. I mentioned Omni-Channel. Clearly throughout the pandemic in the US as well as in other nations, e-commerce has accelerated significantly. E-commerce on the rise even going into the pandemic. But because of the lockdowns and the people staying in place in their homes, the e-commerce has accelerated even more. On average, it's been up about 30 to 35% across the board. But it's important to note that even with that 33% increase, there's still significant amount of transactions occurring in the physical stores in the U.S. $4.8 trillion of retail sales was conducted out of the physical stores. So while the physical transactions are still much more relevant than people realize, because all we hear about is e-commerce, stuff is happening inside these stores. But even if the people are coming into the stores and picking up the goods to buy, the transactions are being done via other means out of the store. For example, there has been a new development over the pandemic called curbside pickup. It's been very popular. The amount of top retailers that have enhanced their curbside pickup has almost quadrupled over this period. 35% of the top 1,000 retailers now offer it. It allows the consumer to order their store online, order their goods online, drive to the store, park in a parking lot, and have the employees bring out the goods to the car, the back seat, and off they go. So it limits social distancing, it keeps it safe, it's convenient, it's become a very popular means of distribution. There's still some delivery done. The evolution of the delivery services have continued, although they're still not making a lot of money because delivery is very expensive. And that's one of the other key reasons these stores will remain relevant, because they are closer to the homes and surrounding consumers. And delivery is very expensive. So that, combined with the fact that grocery and necessity retail is a very low margin business, it's important that the distribution stays near the homes to limit the cost of that delivery, or else the margins will continue to erode to the point where it doesn't make sense anymore. So you're continuing to see these various means of distribution, but again, the bricks and mortar remain the key element of the distribution channel. Next slide, Tanya. And really the proof's in the pudding with some of our key tenants here. If you can see what the sales volumes have done since the pandemic. Giant, Ahold, one of our key grocery store tenants, sales up 11% year over year. Walmart has clearly been up. And the home improvements have significantly. But again, the key point here, I'm going to continue to hammer this home. If you look at the Home Depot, over 55% of the online orders were fulfilled through the actual physical stores. Walmart, although they don't promulgate that data, similarly, the CEO has made comments that the majority of the fulfillment are done through the stores at Walmart as well. And then with the food in general, going into the IPO, approximately 3% of food sales were done via e-commerce. That number is up now, closer to 10. But again, curbside pickup in store, a BOPUS, buy online, pick up in store, all these are means of e-commerce transactions, but fulfilled out of the store itself. So they're actually to the benefit of the store, the bricks and mortar store, and not to the detriment. So the point of the story is these physical stores are very valuable to distribution, and despite the rise in e-commerce, they're going to continue to remain relevant going forward as the U.S. consumer evolves in its behavioral attitudes toward purchasing. Next slide, please. Our management team has worked very hard with the tenancies throughout the COVID environment. I mentioned earlier about the curbside pickup. Facilitated the ease of that by designating certain parking areas to facilitate the occurrence of that. And we do have a lot of restaurants in the South in Florida. And they were fortunate to be able to maintain outdoor eating because the weather is more prohibitive for that. More amenable to that, I should say. In the Northeast, it's a little more difficult because of the colder climates. But we have looked for more ways to get creative with offering common area space to these tenants to facilitate outdoor usage. And then we clearly have had some tenants that have struggled. I mentioned the restaurants. We have provided some relief, most of it in the form of deferment to get through the most significant downturn associated with the pandemic. We've given some relief. We'll talk about that later. But we're very optimistic that the relief we've given will pay off, as some of these deferments now have started to be paid off. And a lot of these tenants now see the light at the end of the tunnel. Spring is coming in, warmer weather is starting to come into the Northeast. And a lot of these restaurants and other type uses believe they can get through if the warmer weather gets here in the spring. So that deferment we gave kind of bridged them through the worst of times to get them through to the warmer weather and the distribution of the vaccine. And the COVID numbers certainly of late have started to drop significantly. And there is some optimism out there that our tenants have made it through the worst of all this. Next slide. Long lease maturity portfolio. I mentioned that earlier. Had very little lease exposure in 2021. Over only 3.4 of the rent roll rolls over. We have been able to renew some tenants during the pandemic as well. We've also been able to do some new leasing. We've lost some tenants, but we've actually added some new tenants. And as I mentioned earlier, the net is we've been able to maintain that occupancy somewhere around that 95% level, which was basically where we were at going into the pandemic. So we're very pleased, and of late, especially in the southern climates, we really believe the new leasing activity has picked up. So there is some optimism out there. There's some green shoots, as I mentioned earlier, with what's going on with the economy and the COVID distribution. And I see I'm getting a note on technical difficulties with the presentation. So I guess, Christine, I will just keep soldiering on here. Can everyone still hear me?
Yeah, Mr. Robert, we are trying to fix the technical issue. So attendees, please just stay with us.
Okay. You just want me to keep going even though we don't have the slides then?
Sorry?
Should I keep going even though the slides aren't showing to your...
Mr. Robert, can I just advise you to maybe sit back a little because maybe you're too close to the mic.
Okay.
Yeah, that's slightly better.
Okay, but can anyone see the slides at this point?
Give us a moment. Louise, can we share the slides again that Mr. Robert was on? Thank you, Mr. Robert. Can we have the slides back on, please?
Tanya, are you still out there with the slides?
Yeah. Okay, Mr. Schmidt, you can go. Yeah. Just be careful not to be too close to the mic.
Okay. Sorry about that.
Don't worry.
So let's move on then from the lease maturity real quickly to the self-storage, which is, even though we're still underweighted in this sector, is an sector we're going to be looking to do more in. Tanya, if you could move forward to the self-storage slide 12. This is a product we're very familiar with the sponsorship. We've developed over 40 of these facilities and have made a significant investment in our development and operation. Again, a class that is geared toward the U.S. consumer and one of the more resilient asset classes over the last 15 years. Demand drivers have been evolving with the COVID. Traditionally, it's been major life events. We call them the 4Ds: death, divorce, downsizing, and dislocation. With these major life events, the U.S. consumer generally downsizes or relocates and needs places to store its goods, its excess goods. Throughout the pandemic, there has been a fifth attribute to the demand drivers, which we call decluttering, with the migration out of urban areas and the work and home trends that we're seeing with the corporations opening up suburban locations. People are working out of their homes, excuse me, and looking to create more efficiencies in their home offices. So they're decluttering their homes to open up office space, and that trend has been a real boost to the self-storage industry. In fact, the occupancy right now on a national level for self-storage properties is about 93%, which is 1% higher than it was pre-COVID. So this sector has continued to thrive despite early shutdowns with shutdown guidelines. There was a pause kind of in the demand during the lockdown, but since May, things have really started to accelerate on a national level, as well as the self-storage facilities that we own have started to climb significantly in occupancy and are actually performing very well. I mean, we expect that to continue. It's just suburban migration, getting out of urban areas, de-densification. We're seeing it everywhere in the U.S. and our actual facilities are outside the metro area, kind of on the migration path toward the New Jersey suburbs. So we feel like we're well positioned to take advantage of this suburban migration. And to go to the next slide, in red, a location of our 4 self-storage facilities. And people are moving out from like Manhattan, Staten Island, and those areas of the metro areas. They're moving out a little further west into New Jersey. Home sales are up, the highest they've been in 14 years out in the suburbs. And with people on the move, looking to purchase homes, being in transit, these self-storage facilities become even more valuable. And really the key ingredient for the success of our self-storage facility is the supply-demand balance. If you look at the chart in the middle of the page, the national average of supply measured in terms of square foot of the existing facilities per capita is 5.9. Even with these facilities in northern New Jersey, we're at 3.1 per square foot per capita. So the supply relative to demand on a national level, there has been an increase in construction, but in the Northeast, again, the balances are still well in favor of the self-storage landlords. The financial highlights. Gerard, you want to take a minute and just hit the financial highlights?
Sure. Good evening, everyone. So to give you a summary of our financial highlights for the period from our listing on 12 March until 31st of December, our distributable income for the period was US 15 million. Significantly, that was 2% higher than our forecast in the IPO. Our second half 2020 distribution per unit was 3.03 US cents. Again, that was 1.3% higher than the forecast in the IPO. Our gearing is still very conservative. It's 36.2%. We do have a $20 million committed revolving facility that was not drawn at that time. Our rental collections for the fourth quarter was very high at 98.9%. And our occupancy maintained a very high level of 94.7%. As Rob mentioned earlier, we do have a very long WALE of 8.2 years. In terms of the self-storage occupancy, there was a slowdown initially in March and April due to the lockdown in the US. But as you can see, we've seen very strong pickup in the self-storage occupancy rates. We're at Carteret at 93.7% for the fourth quarter, 93.4% for Milburn self-storage in the fourth quarter, and Elizabeth, which only opened in January of last year, is already up to 36.6% in the fourth quarter. So overall, for the full year, which is from our IPO from 12 March to 31st December, our DPU for the period is 4.81 US cents. That is 1.1% higher than our forecast in the IPO. In terms of our balance sheet, as I mentioned, gearing is relatively low at 36.2%. The NAV per unit is 0.75 US cents. Next slide. And we have a well-staggered debt maturity profile. We have no refinancing requirements due until 2023. And then even then, we have a relatively well spread out maturity profile over the next few years up to 2028. Our weighted average interest rate is 2.83%. We are 100% in a fixed rate. We took advantage of low interest rates to hedge all of our floating rate debt into fixed rate. And our interest coverage ratio is a very healthy 6.3 times. As I mentioned earlier, we do have a undrawn committed revolving facility as at 31st December of US 20 million. In terms of yield, at that 31st December, based on the price at that point in time, we were trading at a prorated yield of 9% in US dollar terms. Rob, maybe back to you on the portfolio updates.
Yeah, real quickly, we do have 2 development deals. I mean, this is an income-producing REIT portfolio, but we do have 2 development initiatives. One actually has just been completed. One that you're looking at here is very close to being completed as well. This is an existing property in Port St. Lucie, Florida, with a Publix anchored grocery store. On the same site, we built a new Publix store, a larger state-of-the-art grocery store. The tenant will be relocating from one side of the property to another into a much more modern, more functional layout and a bigger layout as well. We actually expect to turn that over to the tenant very shortly. The tenant will need to move in. It's going to take about 30 days to relocate from its existing store to its new one. We're very excited about that. It's creating additional revenues for the project, and we get a new state-of-the-art Publix as well. At the same time, the backfill for the old Publix is underway. We signed that Bell's lease actually almost a year ago now to take the 57% of the existing space, and we have actually a really strong amount of leasing activity for the balance of the space. We're cautiously optimistic. We're working with LOIs that we'll have leases over the next couple months to finish backfilling the remaining portion of the old Publix. The other development initiative is another self-storage facility that was opened up in January, right after the end of the new year, and we're already, as of February 2021 there, as you can see, 8% occupied. So our occupancy is trending above the forecast there. We're real excited about this project as well. In terms of the outlook, there's some green shoots out there right now. There's no getting around it. Obviously, most of you are aware of the most recent stimulus package that was formally approved last week. The 1.9 trillion. A lot of that is stimulus checks directly to consumers, making 75,000 single, 150,000 for couples. There's extended unemployment. There's also a direct allocation of grant money for restaurant users, which we're very excited about because we think our tenants can benefit directly from that. So the combination of that stimulus, along with the dissemination of the vaccine, which is really accelerating lately, and we're reaching to the point where we're getting almost 2.5 million doses out there a day. At this point, over 100 million doses have been administered. I think the numbers are somewhere around 15%, close to 50% of the U.S. population has now at least gotten one dose. We still got a ways to go there, but there is some optimism out there. There's some estimates that the GDP for 2021 could reach 6%. So there is some optimism. The employment situation, unemployment dropped to 6.3% in 2021. Manufacturing is showing significant signs of life. Housing construction. I mentioned earlier that home purchases are up the highest number they were in 14 years. And with that suburban migration, we believe that is going to continue to prop up the construction industry. And then, retail actually did very well over the holidays also. There was a lot of hiring in the retail sector as well. And also important to note, certainly unemployment at 6.3, while going in the right direction, is still higher than it was pre-pandemic. There are still less jobs. But one of the positive outcomes of the pandemic and people being locked down in place is their savings rate is significantly higher than it was pre-pandemic. On average, the savings rate is about 14% for the U.S. consumer versus 8% pre-pandemic. So the consumers' balance sheets are actually healthier right now. So as we continue to move and transition out of the COVID environment, we expect people will be out spending that money as they get out of the house and start to travel more again, and we can really see a significant turnaround in the upcoming months of 2021. In terms of the sector itself, I started off the presentation by highlighting the differentiation between our necessity-based open-air sector versus malls. Malls were dying going into the pandemic. The situation is even more dire for malls with the pandemic, and as we go out, a lot of department stores went bankrupt during the year, such as Neiman Marcus, JCPenney, Lord & Taylor. But there are new stores opening in the open air sector. In fact, some traditional mall tenants are moving over and looking for space down open air centers. You have grocery stores looking to open new units. Aldi's a good example. You have off-price clothing stores like Burlington, TJX, and new stores opening. Bankruptcies were significantly down in the fourth quarter. There are only 6 bankruptcies in the fourth quarter. Things are trending in the right direction. We talked a lot about Omni-Channel. I can expect that investment in the Omni-Channel distribution will continue. Also talked earlier about the increase in curbside pickup. I think those types of trends are going to continue. But again, you're going to see that the bricks and mortar store will remain a critical element of the distribution channel. These stores are not going away. And as far as the capital activity, the transaction activity, because of the reasons we discussed today, necessity-based tenants that have held their book values, appraisals have held strong. There has not been a lot of investment activity just because of the uncertainty with COVID. But the retail that has traded has been in this grocery-anchored sector. Over 30% of the transactions were grocery-anchored centers. They maintained their occupancy, they maintained these performance levels that give credibility to this sector and give a positive outlook to that going forward. I think, I don't know if we took the appropriate amount of time, Christina, but I was going to leave it at that. And I don't know how much time we have for Q&A, but I thought I would cut it off and see if there's any questions out there.
Yeah, thank you, Mr. Robert. In our last segment, we will have the Q&A session. Should you have any questions, you may post your questions in the comment section below. And due to time constraints, we would like to seek your understanding that not all questions may be addressed. So without further ado, I would like to invite Mr. Richard Dyerson, General Manager, Planning, Education and Research, SIAS, as well as our panelists from United Hampshire US REIT, Mr. Robert Schmidt, CEO, Mr. Gerard Yuan, CFO, and Mr. Derek Gardella, Portfolio Manager. Thank you.
Good morning, Rob. Welcome to Singapore and welcome to, and actually congratulations on your listing on a very, very challenging time. I think it took a lot of guts between you and me to actually list during the middle of a pandemic, but congratulations. And it looks that you guys are heading it through, because you can't have an investor presentation without talking about the C word these days. And I think in this case, it's congratulations for actually a job well done, because it can be seen that you can see that your dividend yields, despite the pandemic, you've also had improved DPU and distribution income for the year ending in 2020. Yet these financial results are retrospective in nature and do not tell very much of the current environment. So maybe we want to talk a little bit more about what are the means, or example, the extent of visibility that you as a manager have over the environment in the US moving forward. Can the REIT manager provide an update on what is happening on the ground? For example, operations people. So I think you talked a little bit more about earlier, you brought in a little bit, put some color into that. Hey, they're getting some, restaurants are getting some rebates, etc. Some of these, so if you could provide some color and provide this operation on the ground aspect so that investors here have a better understanding of what's happening over there.
Yeah, that's a great question. It's been challenging for all of us as landlords, as tenants, as consumers. It's been an environment that none of us really have lived through before. So, but that said, I feel like everyone has really kind of been resilient, kind of kicked into survival mode, and really innovative ideas to work with the tenants as they bridge through this unprecedented environment. And I give kudos to the management team for being on the ground, as you stated. And I mentioned some of these things earlier, but I mean, the key to working with the tenants is to be in communication with the tenants. You have to know what they're thinking. You have to know what their needs are. And we look at our tenants as long-term relationships. It cannot be pay the rent or get out, because we understand these are extreme circumstances. So with restaurants specifically, as I mentioned earlier, we have helped them create more space for external setup, external seating, things like that. We've done deferments where in the real toughest times, when capacities were down, we agreed on several occasions to forego certain amounts of rents to get it paid back in future periods. Some of it was deferred into 2021, and we're getting off to a good start in 2021 as restaurants do become healthier and are starting to build up that revenue stream again. I will say, though, that not all of our restaurants took as big a beating as you might think. And those restaurants that have hung tough are those restaurants that, for the most part, have had certain infrastructure built into their distribution prior to the pandemic, being pickup windows, like pizzerias are pretty big in delivery anyway. The fast food had pickup windows. Those stores actually benefited. I mean, there's a chain called Chick-fil-A. You guys may know Wendy's. To get a Wendy's cheeseburger, pandemic was tougher to get pre-pandemic alive, or 30 cars. So it's not all the restaurants that actually suffered significantly. The restaurants that we had to help the most were those ones that were more dependent on, I would say, higher quality, higher end indoor dining that really relied on sit-down business. Those are the tenants that we had to work with the most. So those are the types of things that we had to do to help tenants. And then the health clubs I mentioned is the other sector that we really had to work with. Our biggest exposure is with LA Fitness. It's one of the largest chains in the US.
Yes.
We're very committed to seeing this through. One location is in Florida, one is in Garden City, New Jersey, and Long Island. The reports back from LA Fitness, we did give some abatement, but we did that as a trade-off for extended term. They were confident on the rebound, so they agreed to give us additional term on the leases in exchange for the abatement. And the reports are they're doing very well. Capacities still are limited, But in New York, for example, the capacity is about to go up to 50%. Florida, the capacities were already at a higher amount, and the feedback is very strong that these tenants are starting to bounce back. And you read a lot about Peloton, people working at home, but the element of working at home that these health clubs provide is the social element of getting out and working out with other people. And while there's going to be some short-term socioeconomic behavioral changes, I think people working in the house, we are starting to see signs of people getting back out to the health clubs to take in that social aspect of working out. We don't think that's going away. We expect that trend to continue.
Oh, I can expect the minute we can travel, a lot of your unit holders will be flying over there to actually look at their investments and see how they're running. We have actually quite a fair bit of questions, so let me just take them. So there's one from Gerard as well. So in terms of valuation, why is the cap rate for self-storage much lower than a retail space?
Yeah, that's a good question. Well, first of all, the cap rates for self-storage were lower than necessity retail, even going into the pandemic. And especially, I will say, in the Northeast New York metro area, I mentioned earlier on about the supply-demand balance. Supply being very low compared to the total demand in the northern New Jersey and New York especially. On a national basis, cap rates, I would say, are higher, closer to that 6% range for self-storage. But in the Northeast, in the New York metro area, you're 5, even 4.5 in some locations. And it's just because of the historical performance of self-storage since the Great Recession. It was the first asset class to perform. A lot of people wouldn't realize it, but the demand for self-storage has been very consistent over time. In self-storage, one of the best performing REITs in all asset classes is a company called Extra Space, and we use them to manage most of our facilities. They were the strongest performing REIT over the past decade, bar none. And it's the consistent demand. Self-storage are very convenient for the consumer. It's very inexpensive relative to their other household liabilities. And there's a lot of small, undersized homes in the Northeast. And Americans don't throw out extra stuff. They're known for just carrying on and holding their junk indefinitely, and they need a place to put it. And there's a stickiness to self-storage. Once the stuff gets in there, people almost forget about it. They give their credit cards to the self-storage companies every month. There's a $100 debit, and they don't even think about it. It's a really good business model.
I think they need a Marie Kondo over there.
Yeah.
There are a few other questions, and I'll quickly run through them because we know that we're running out of time as well. One other question: the top-up income support for St. Lucie will end in 2021. Any risk that the contribution from this property will go down after 2021? Who will take that?
Gerard, you want to take that one?
So as
Or
you know,
Derek?
the top-up income for St. Lucie is because we are building a new space for Publix, our existing supermarket tenant. So actually we just announced it yesterday. So that store has been completed and Publix will be moving into that new store. They signed a new 20-year lease there. We've already backfilled 57% of the existing space that they'll be moving out of. And we're working to fill up the remaining space. The top-up doesn't run out until October of this year of 2021. So we've still got that period of time to backfill the remaining space, at which point of time, then the yield will be back.
I hope it answers your question, people. I've seen this in various forums and so forth. One of the key questions a lot of investors are asking is that withholding tax. Because a lot of them are thinking, if I invest in a US company or US with the REITs, will I, as a Singapore resident, have withholding tax, especially for the dividend yields?
I'm going to let Gerard answer that one as well. That's a good question.
Well, I guess the short answer is no, in the sense that we are listed in Singapore, so there is no withholding tax payable. The tax structure that we have in place, because it's interest income that we pay from the group into the S-REIT. So again, there's no significant withholding tax there as well. The main tax leakage is a state tax leakage, where we have to add back the related party on the interest on the shareholder loans. But that's a relatively low figure. I think in the prospectus, we put it at about 2.5% state tax. So no, there's no withholding tax because we are listed in Singapore. Whereas if you, as a foreign investor, was to invest in a US listed REIT, I believe you'd have to pay 30%.
Yeah. So I think that was the clarity of understanding the difference between a US listed and investing directly in the US REITs. So if we were to, there was a question in terms of what are the possible risks? Could you highlight again? I think maybe at that point in time, Rob, there was some, the clarity may not be. What are some of the possible risks to the business model? Could you just share a little bit of that?
Yeah, I think I hit on some of it. I mean, the retail right now is going through an evolution. Earlier on, I would say pre-pandemic, the e-commerce, the evolution of e-commerce, there was concerns that retail was going away, and why would there possibly need to be bricks and mortar stores? That was always a risk. Is e-commerce going to take over the world? But really, I think our business model proves out that that's not the case because of costs, deliveries, the need for the U.S. consumer to touch and feel its groceries, not so much during the pandemic. But again, we can't lose sight of the fact that 80% of retail sales are still done out of these bricks and mortar stores. So to me, the biggest false rumor out there is e-commerce is going to take over the world. And while, yes, it's going to continue to evolve, the bricks and mortar are not going away. And the risk for certain retailers who are not going to survive, for me, you're going to have to invest in the technology to adopt this omni-channel strategy. You're going to have to be creative to figure out means to continue to get goods and services to the consumer in a convenient, frictionless way, but you're going to have to take that investment. If you just continue to do things business as normal and expect all your consumers just to knock on your door and buy stuff from you, you're not going to be around that long. You got to be flexible, you got to be adaptive, you got to be creative, and you got to invest in the technology. So to me, the risk is the tenants that don't do that may eventually work themselves out of market share and ultimately go away. So the key is, the risk is, as an operator, finding these centers with the right tenants that are going to make that investment, that look around the corner, that anticipate changes, that are nimble and adopt change and are willing to invest that money in the technology of the cashierless checkouts. Amazon's opening grocery stores now. And to me, that's one of the biggest justifications of our industry. Amazon, this company who made its mark by e-commerce delivery, is putting up physical grocery stores. They've opened 28 in the US to date. They're looking to open more. They understand how important it is to put bricks and mortar stores in neighborhoods where they can cut down that delivery cost. So we believe this is not going away. There's risk, but if you find the right retailers, you're going to do fine.
I think it's about making the right environment. At the end of the day, is the environment that people want to. And you said earlier, we've all been stuck at home. I don't want to just click on. I want to get out. I want to interact. Talking about buying stuff. Do you intend to make acquisitions? And what are your plans of acquisitions in the next year or so?
Yeah, clearly we want to grow this REIT. Obviously, it's a small size REIT. We went into it with the idea to grow it significantly. I would say the first 12 months we've been playing a lot of defense, keeping our portfolio intact, but we are now actively looking at new opportunities. We have 2 deals right now that we're pursuing contracts on. One's a self-storage facility, and one is another retail property within our marketplace. I don't want to give too much specific details, but we're also looking at some portfolio opportunities. There is certain private equity funds in the US that have a specific durations, and they're under pressure now to exit some of their real estate. So we're looking at a potential portfolio opportunity. And then there's some undersized REITs in the US that are looking to dispose of some assets as well. There may be a portfolio opportunity as well also. And then the Hampshire sponsor has a pipeline of self-storage development deals that conceivably could be source opportunities for self-storage. And there's also a couple redevelopment retail properties that the Hampshire sponsor controls that we're looking at once they're stabilized to get them into the REIT. I mean, again, we want to limit the amount of development in the REIT. We want properties that are ready to go, income producing, so we can pay out that distribution to investors and maximize the income return. So, but with that said, there's some things in the works in the sponsor that within the next couple years that we can see being a conduit to growing the REIT also.
So one final question: any concerns from possible tax increases from the new administration? They still have to pay the $1.9 billion that they are dishing out, right?
Yeah, I mean, there's a lot of talk about new taxes with the Biden administration, new individual taxes on high net worth individuals. He's talking about potentially doing something with the capital gains tax, corporate tax. I mean, he's talking about all kinds of taxes. At the end of the day, you know, we just don't know what it means yet. I mean, the real estate sector is strong. I think it will continue to be resilient despite what Biden comes up with. And ultimately, to get such structural tax policy changes, he's going to need cooperation from the Republicans as well. And I'm not sure if he's going to get the significant changes he's looking to get anyway. So we'll have to see how that plays out.
Thank you, Rob. Thank you, Gerard. Thank you for dialing in this morning on your side. I think, you know, it's still early on that side. Thank you very much, and I'll probably give it back to you, Christine.
Thank you.
Thank you, Richard, Mr. Robert, and Mr. Gerard, and Mr. Derek. We have come to the end of today's session. It has been a pleasure to have with us today. In case you missed any part of today's session, you can rewatch the session on SIAS Facebook page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead. Thank you.
Thank you.
Thanks, Rob. Thanks, Gerard. Have a good day.